Asian stocks declined after exports from Japan fall the most since the aftermath of last year's earthquake. Caterpillar will be one of the big earnings reports watched this morning as investors look for clues about the health of the global economy. I'm Lindsey Bell, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Lindsey Bell with TheStreet, and together we bring you the morning call. On Friday, we saw a major pullback in all stock markets. The NASDAQ got hit a little bit harder, but the S&P 500, they took back all the gains from earlier in the week. This morning, though, interestingly, futures are pointing to a positive upside a little bit here. How do you go into trading today?
I think most were expecting a down open, trying to get some downside follow through to Friday's potency. But when you're down 25 handles-ish in one day, typically that's a lot to absorb. So being up 5 to 7 handles this morning, isn't something that's at a whack, so to speak. So what I think, though, is a lot of traders are going to come in and use this as an opportunity to sell. They're going to probably try and get short. The question is, can we go, from an up open and give it back and trade through Friday's lows and get pressure today? Or do they try and, does the market try and absorb Friday's down move over a recession or so before continuing to the downside? But last week, earnings were coming in and the market just felt heavy. Technology continued to lead us lower. We had reports coming out from an IBM, from various other important stocks where pressure was just, leaning in there. And then on Friday, when 1445 gave out, that was like the last line in the sand for commitment. And that was probably the last spot that anyone who was trying to stay long for what it could have been, constructive prices, probably gave way and said, you know what, I'm going to take a step back. I took a step back on Thursday. I think a lot of other people took a step back on Friday.
We also got a disappointing earnings report from Caterpillar this morning, so that should actually weigh on the market. What levels are you watching in the S&P?
Well, first thing, take a look at the S&P. We've had this upper range. So if you go to the chart here, you will see that, earlier in the week, it did try and look constructive. If you take a closer look here, you will see that, remember we had the snapback off the 50-day, came back up, held here for a day or so, and within this range of the market, the home builders were acting okay, financials were acting okay, but technology was a problem. Leading stocks were a problem, and this was Thursday. And then I think finally, the straw that broke the camel's back was on Thursday when Google came out, midday and was down 50 points and things started to sell off. That was your, clue or your red flag to get out of some stocks. And then on Friday, if you were not out or if you lightened up and you wanted to see whether or not there'd be commitment, once this 1445 gave way and we didn't hold the higher end of this range, that was your stop. So now, we are bouncing a bit. We're back at the lower end of the range. I would say now, the longer we stay below this 1445, the higher the probability we take out this lower range. And then, below you have an area right around 1396 to 1398. And then a major spot that I think would contain the downside in the next week or so, and that's around 1380, where both the 100 and 200 day, come in together.
In the sector spotlight, let's look at some of the different sectors in the S&P 500. We'll start with the Qs. The tech sector, it's been weak lately. On Wednesday, it tried to test its 50-day, but failed. On Thursday and Friday, we saw good downside here. It was down 2.5% on Friday. Google last week, IBM didn't help the sector. This week we're going to hear from Apple, and we'll touch on that stock later. But do you think weakness can continue here?
Well, it's been a pretty drastic down move, and the important part was noticing it before. You never want to get out on the last possible day, and if you remember, if you look at the chart of the Qs, technology was the first group to break the 50-day. That was right here. So when technology broke the 50-day, when you saw this head and shoulders pattern start to trigger, this is when you should have started selling your stocks. Remember on unemployment day when it actually opened up and failed? Here was your clue number one. If you didn't take that clue, this was your spot. Okay, and then, it continued lower, and if that wasn't your spot, you had a retest. Okay, came back up to test that broken support. So this could have been the area where you lightened up. You never want to be lightening up or selling your longs into the downdraft. So now here we are, the measured move of this short-term head and shoulders top was met. So nice spot to cover some shorts on Friday. Now you have to figure out, can we bounce back up and maybe test this little support, area, which was 66.50. And then if just say we try and bounce up and it can't reclaim this area, we could see further downside to the 200 day. You know, your pivot on the downside is 65.60. Write that down. So on this bounce up, if it gets contained right there, that's probably a spot to sell some. And then if we take out Friday's low, you know, here's your 200-day moving average, which wouldn't be such a far-fetched thing to touch.
A different story has been the home builders. They've been one of the strongest sectors all year. They continued their strength last week, even on Friday when the market was weaker. They were leading. This group, last week we saw starts and permits were stronger than expected, which bodes well for the group. This week we'll get new home sales. Do you think the momentum to the upside can continue?
Well, this is one of the positive spots, but the more pressure the market gets, the more people are going to see whether or not this could hold. So what I want you to do is just have high-level stops. Don't abandon the strongest groups, because once the market turns, when it turns, these are the groups that show you the best returns or the best alpha, but you have to measure your commitment. So if you look at the chart of the XHB, like you said, look where this is. This is hovering near the highs. Like I just showed you the Qs, you know, going to the 100-day almost. So at this point, I would say, you know, watch this area. Okay, same way 1445 gave way in the S&P. Make sure if you want to stay committed on a really short-term level that this gap holds. This is 2570. I think as long as we stay above this area, you will see short-term traders stay involved with the home builders. You know, on a more intermediate level, I would say if you want to give it more room, you know, why not give it to 25, 27? But you know, support 1, support 2. If this were to break below this middle area, then I do think some pressure comes in. So I would say watch this area. And again, if today's bounce builds, you're going to see some more follow through in the home builders. But again, here's your commitment levels. It's still following the 8 and 21 day. If this were to break, get out of the way. That means something might change here.
Retail is a group that had been acting better until the end of last week. It broke down with the rest of the market. It touched its 50-day, I believe, but it's using that as support, and it's worked as support a few times. Do you think that it will continue this time?
It's going to try. And I know that this group has gotten a little bit more loose, a little bit more wide, and you know, there's been divergences between stocks, so that tells me to just be a bit cautious. Retail's been great. You've had big moves in Walmart, you had big moves in Target, a lot of these things throughout the course of the year, but then when they flash warning signs, you lighten up. You go from tier 2 or tier 3 to tier 1. Maybe you start hedging yourself. If you look at the RTHs, you'll see, you know, starting to get some choppy whipsaw action in here. So with that said, it's still above the 50-day moving average. So at this point, if that's what you want to use as a stop, okay, it looks like it's trading in line with the spiders, you know, or the S&P. So it's not showing relative weakness. It's not showing relative strength. It did break this little high end that might have gotten some people out. So now we'll use this as your stop. Okay, 44.70-ish is your pivot. If it were to break this area, you know, and the market gets follow through to the downside, there is a chance for it to get down to 43.36. So just be a bit cautious here. Know your time frame and know, you know, whether if you do sell it here, if you would be buying it back there, because you know, just, you know, a lot of macro investors try and be cute, but they never get back involved, and then they miss higher prices, you know, down the road.
Right. Financial sector. This is a group that it's been holding in pretty good since the end of September. It's above its 21-day. It's holding its 8-day. Can this continue to hold if the market continues to decline?
Well, you have the haves and the have-nots. Okay, like we said, technology weak, a lot of other sectors weak. The two strongest sectors in the market right now are the home builders and the financials. There are some technicians pointing to a double top in the financials, so we need to see if that develops. So if you look at the chart of the the XLF, all right, here is the first peak, right? This peak came in right at 1644. Here was your other peak, okay? Just right there. Could be the small makings of a double top. I'm not in that camp. I'm not sure yet, you know, but at this particular point, I would say if you want to have high level stops, here is your area, okay? We could actually change this pattern up a little bit and show you some type of channel here where this is support, here's the resistance, and here's the middle area. As long as it holds the middle area, you'll see short-term traders trying to stay long. If it were to give way to this middle area, more macro investors would probably have to worry about this area. So, you know, let's watch and see if these strong sectors can hold up, because typically if markets start to get further follow through to the downside, even the strong sectors correct, and it's hard to be in anything long, because usually when the tide's going one way, it's hard to buck that trend.
It is hard to buck that trend, so we'll keep our eye on that. We're going to take a quick commercial break, though, and get back into it with the trenches.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back. We're going to get into the trenches with some earnings that are coming out this week. We'll start with Caterpillar because it came out this morning. It was a disappointing result. Management guided down. People look to this for information on the global economy. The stock is down in the pre-market. So Scott, what are you watching here? It's been in a downtrend since September when management took down their 2015 guidance and warned that they were looking at 2013 as a potential recession year as one of their outcomes.
Well, when we entered earnings season, a lot of these stocks have come down. A lot of people thought, okay, earnings are going to be bad, guidance is going to be bad, can we price it in? So a lot of the action recently has been to price in some of these poor earnings, but sometimes then when they report, they're still not priced in. So I think for Caterpillar to set the tone for this week, it'll be important to see whether or not it opens lower and continues lower or potentially tries to go green or comes off those lows, because again, you look at the chart of Caterpillar, it's no surprise of the weakness. Look where the highs were. You know, a high, lower high, lower high. This is when it broke support. This was a way out of the stock. Then finally, after hitting bottom, you had an oversold bounce that got contained by the 200-day. And if you look right here, it really, is showing you that the report was not expecting much at all. So the question is, was the report bad enough for it to break this area? The low here is around 82. If this were to break 82, you could see it move down to the recent lows. So the question is, for downside action is, can it hold this support? Look where it is. It's not like it's trading up here and people are like, oh, Caterpillar is going to be great. They knew that it was going to be bad. The question is, was it bad enough to break 82? I think some guys are going to look to see if it's buyable, but if it's not buyable and it breaks 82, get out of the way, because then the next level here is comes in around 78 and a quarter. So with that said, I think Caterpillar is very important to watch today, and I know for short-term traders, it's something we're going to look at for some opportunity as well. Yeah,
I definitely think expectations going into that one were lower. Another company reporting earnings tonight after the close is YHOO. This will be Marissa Mayer's first conference call as CEO of the company. I think investors are really looking here to see what her vision is for the company going forward. Any clues there could be a positive for the stock. But, I mean, if you look at this chart, it's been trading in a really tight range for quite a while now. Could there be a trade here?
It could be, because like you said, what I look for is tight ranges over long periods of time. I mean, somebody's got to own it. And it's just a matter of whether it's enough, whether people like the numbers enough. And I think people are trying to be optimistic on YHOO. And if you look at the chart here, you will see that look at the size of this channel. This is enormous. Means this stock has done nothing for, what is this, almost a year and change, probably even more than that if you go back. So here's the channel. Okay, where, this is what is this, around 14 and change, and then here's your upper end of the channel. So I guess if they come out with the good numbers and they sound optimistic and it starts getting above 1635, right now we're at 1584, I think some traders might try and go with it. So unless it has to get over 1635 and has to stay above that for any traders to have any interest for it to potentially, head to that $18, $19 resistance. I don't think this is that important for the overall market sentiment, but as a trader, it is something worth watching, considering it's been in a huge range for a while, and we like points of reference, and 16 and change would probably squeeze some shorts and get some longs, maybe re-energized there.
We took a look at the retail sector overall earlier, but let's take a look at Coach. They're going to report earnings tomorrow. Last quarter, they had a big miss. The stock pulled back. There was issues with couponing in the factory sector. This time, I think investors are going to be watching what sales do look like in North America. I mean, 60% of their operating profits come from there. And there's concern that Michael Kors and others are taking share from these guys. China, they also have a presence there, so we'll get some clues on the economy there and the consumers there as well. But looking at the stock, it hasn't regained the gap down where it was before the gap down in the second quarter. So what would you look for here?
I just think it's a non-event. I think that you must really want to be a Coach fan in order to own this thing. I think, common sense wise, I don't think the economy's gotten much better. And if the last quarter or so is weaker, why would this one be stronger? Everyone just all of a sudden started buying handbags over the summer, especially expensive ones like Coach. Anyway, you look at the chart, and the chart tells me, it's really not expecting much. This is when it put in its highs. It's meandered all the way down to finally the last quarter. Did hit a capitulation low. There was a trade there the last quarter. If you remember, look what it did. It gapped down, gave you a red dog reversal right here on this third day, made a new low, came back up, beelined higher, held higher, and then it failed at the 200-day. So it's trying to hold higher. I'll look at it after, but I don't think any trader is going to be taking this long or short. I think most people, if they're going to take anything, they'll probably take it short, but I don't even think that's worth the risk. We'll just trade it after. You have the low here of 52.77. Here's your resistance that comes in around 61 and change. And if it's really, a bad report, it could see this low here in a flash. So just be careful here with Coach.
Boeing's going to report earnings later this week as well. That stock has had some nice momentum in the last month. That just means probably expectations going into this quarter are pretty high. So do you think this is a place where maybe you take some profits?
Going into it, definitely.
Yeah.
If you're uncommitted and you just saw a decent percentage gain for Boeing, which hardly happens, take it. But it also depends on your time frame. I think a lot of institutions, are more in Boeing versus individual investors, and this too also hasn't really done anything for like almost 2 years. You look at the chart here of Boeing, and you'll see. Look at this monotonous, crazy long range. This has been almost what is this? Almost 2 years or so. Anyway, with that said, so here's the low end. Here was that last gap that held right there, coming across. It has been acting a little bit better. If you take a closer look, it is above all the moving averages. So it is actually outperforming the indices where, it's above the moving averages. So people are starting to get optimistic here. So this report's going to have to be good. And if it is good, here's resistance number 1. This is around 76. And then you have the highs, which are right around here. So, this, I think, just like a caterpillar, the street's going to be looking at it very close to look at it as an economic gauge. And right now it's acting better. Resistance 1, resistance 2, and just know your time frame if you're going to take it into the earnings, because taking stocks into earnings has not been very profitable lately.
No, it hasn't. Let's do some quick hits. We'll start with Google. Last week we saw that stock get crushed after earnings came out in the middle of the day when it was unexpected. Do you think that the damage has been done? Can we contain the move that we've seen?
I think the stock just broke. And there's a lot of damage there in many different levels, psychologically and chart-wise. I know for me and for my guys, it was a great opportunity. For some reason, I wasn't at my spinning class when it came out on that, Thursday, and it was down like $10 real quick, and everyone's like, "Oh, Google reported." And if you knew what they were looking for real quick, there was opportunity. That's why you always have to be prepared. Stock had a major run up, $120 going into the report, so it had to be really good, and it had to be, it just had to beat on every metric, let alone missing. So if you looked at when it came out and it was like $9 versus what was expected, you had some opportunity to get short. And if you look at the chart here, this was last quarter. It had a good earnings report. This was your entry. You had an additional entry when it took out the highs of the year. Here was your run up as it followed the 8-day moving average. We talked about selling within this area if you were not going to take it into earnings. Why stick around after a big move? I also talk about one of my rules is I don't trade stocks on earnings day. So if you come back to me, 2 rules. 1, as an intermediate trend trader, I tend to only trade stocks after the earnings report. Sometimes during the day, before the release, people are like, "Oh, they're trading it." I also think that's a little risky because there's so many funds involved in that name heading into the earnings report that composure could change so quickly that something could happen to you where it goes from weak to strong or strong to weak, and it could blow you out also, let alone coming out with earnings early. So you go back to the chart, that was then, this is now. It sliced through important support right here. It lost a 50-day right there. I guess you could say you have a small point of reference to trade against right here. This is 672. It might try and bounce up a little bit. It might try and go sideways. But I think ultimately, the 100 and 200 day are going to be a magnet. Before, if you're not involved in Google and you're looking for a macro entry, I do think that you can get a little bit more of a precise one right around this area, or wait for some type of 80-20 red dog reversal just for a trade. So at this point, I think it's a two-way trade. Hopefully, you didn't get caught in this mess of what took place there. And I do think if you're looking for opportunity, you can get it a little bit lower right into here. And then ultimately, that's still not a bad price. And if you bought Google correctly here or here, and you said, "I'm going to hold it for the long term into earnings," you're still ahead of the game because you didn't chase excitement. You bought very prudently, so to speak, down there.
Apple, another tech name. Let's take a look at that. It broke its 100-day. We're going to get earnings on Thursday. How do you trade it ahead of that?
Well, a lot of guys have been trading it both long and short. Ever since it broke the 21-day, it's just been a two-way trade. To the long side, to the short side, obviously more to the short side. But if you look at the chart here, you will see there's been even actually a trend here. When it broke 683, that's when I was on Kramer. That's when it broke to 21 day. I'm like, now tread lightly. It's a two-way trade. You know, from there, you had to move all the way down to just say the 50-day, gave you a 3-day bounce before not holding the 50-day, giving shorts a signal to lace in there. Here you had more follow through to the downside. This was the first time I tried to hold the 100-day. I remember buying it there, gave you another 3-day bounce, and that was your sell signal. And then it came back and retested the 100-day. What did it do? Another 3-day bounce before giving you a small little active reversal right there. And then what did it do when it, you know, broke the 100-day? It sliced through it. So here's what we know. We know Friday's low is 609.62. You know, so as far as short-term trader, you know, it's up $3-4. I think some guys are going to try and short it right here. Okay, 620-ish. You know, actually, it's going to be a big range now, but anywhere between the low here of just say 623 to almost 627, that would be a spot to fade some. And if it's really weak, it probably won't even take back half of this wide range bar, so it won't even get back above 620. So if they sell it, it goes below Friday's low. You know, the next real spot here comes in at really around 600.25. So know that area. And then on a macro basis, look where the 200-day is. It's pretty close. So with a week of events, if iPad mini fails to impress whatsoever, you could see the 200-day. And then, you know, as we get closer to earnings, we'll come up with much more of a strategy on the macro level, considering from 700 down to 580. You know, there'll be a different way to look at this thing to see whether it's priced in or not.
Amazon's another one that's been a two-way trade lately. We're looking for clarity going into earnings, which will be on Thursday. So what are you looking at here?
This one will be a quick hit. Okay, just real quickly, go to the chart. I don't like talking about Amazon so much. Here's your pivot low. The pivot low is 238.94, and here's the 100-day. It's acting a little bit better than the other ones, but you know, Amazon typically does. So I would be a bit careful here also. 236.46, and then there's the 200-day.
All right, well, actually, that's all we have time for. So be sure to check in at the end of the day for the daily recap with Scott and the T3 Live team.